All right, everybody, welcome to another episode of the world-renowned podcast, Remodelers on the Rise. I say that because Nick, and I'll introduce my guest in a second, but I had somebody from Europe, from the continent of Europe, reach out who is a listener. So now I kind of feel like it's not a North America thing; it's a worldwide podcast. Is that pretty impressive as far as you're concerned?
It's very impressive. I mean, you're about to break the internet, it sounds like, going
So yeah,
global.
yes, yeah. I'm gonna break all these records. Who I have with me today? A lot of times I am interviewing maybe a colleague who's in the remodeling industry. A lot of times when I'm doing the podcast, I'm interviewing current clients or previous clients that I've had, and they're sharing their stories. And Bailey, my marketing director and employee, and I were brainstorming upcoming podcast topics a month or two back, and I thought to myself, what would make some wonderful content would to have my longtime friend and financial advisor Nick Hopwood with Peak Wealth Management. He's here in Michigan, specifically in Plymouth, Michigan, and Nick works with a lot of small business owners. I've worked very closely with him over the years. We talk marketing in between, business in between, talking about financials, and I thought, my remodeling audience, my clients and my audience, we need to be thinking and talking about retirement, maybe a little more than we are. There's some people that are in good shape with it and they have a plan and they can trust the plan. Nick, smile, Nick. Come on. Okay.
Trust the
We
plan.
just we
Yeah.
were just talking about that beforehand. And there's other folks that are like me, maybe from 6, 7 years ago, where you're like, oh, I should have been doing more in my 20s. Oh, I should be doing more now. And you're playing a little bit of aggressive catch up with your retirement. Wherever we're at, we need to be thinking about it. We need to be wise about it. And that's what I'm going to interview Nick about today. Nick, welcome.
Thanks, Kyle. And let me just say, I think, Kyle, we go back like 18 years or so, if I'm not mistaken.
Yes.
And a couple of years after we met, right, you went out on your own, which
Yep.
I admire tremendously. And I still use a lot of the things that you taught me back in the day, like
Ooh.
2006, 2007, duct tape marketing type stuff.
Yep.
And like I said, I'm still using that stuff. And you found your niche, right, with remodelers, right?
That's
And
right.
you know, I'm, but it saddens me because we wanted to use you for marketing, but you said I can't help you. I'm only working with remodelers.
Sorry, my
So what's up
friend.
with that?
Well, in the world of business and marketing, you can't be all things to all people, Nick. It's just it's
You got
just
to
the
find your
reality
niche.
of it. We got to find our niche. We got to, or some for the fancy listeners, we got to find our niche. And it's actually, I remember us having that conversation, and it's been something that over the last, in particular, couple of years, I've had to grapple with more and more. You only have so much capacity. You only have so much energy that you can give to your clients. And when you found a niche that you serve and you've gone deep into that, you got to be careful to make sure that you're working with your ideal clients and the people that you can best serve. Right. So I think it's something that we all as business people need to think about. And what's been on my mind lately, which is also another spinoff of that, is I have said I've said no to more opportunities in the last 4 or 5 months than I probably have in the previous 4 or 5 years. And one of the things that clicked in my head was, Kyle, you only have so much capacity that you can take on. Make sure you're very clear with what that capacity is, and you have to create a waiting list, or you have to say no to opportunities that aren't a great fit. That is very hard for me to do because I'm a people pleaser, and especially if somebody's been following my work and I could help them, it's a very difficult thing. But the thing that clicked for me was, I can shove a bunch of meetings into my work day, into my 9 to 4:30, my 8 to 5 ish range, and work during that time. But if I don't give myself a little more time during those hours, all of a sudden the emails and the other work gets pushed into the start and the end of my days. And that directly impacts my ability to be a good husband, to be a good man of faith, to be a good father. And now all of a sudden I'm saying I'd rather disappoint somebody for now, and hopefully it's just temporarily, and then I can bring them on as a client, than disappoint these other areas of my life. So that's also part of narrowing your focus, is making sure that our business isn't taking over our work-life balance.
That's well said. Very, very wise
Hmm.
mindset
Well,
there.
I am
I like
almost 40, so
it. Yeah.
I'm getting smarter, getting smarter. So Nick, why don't you introduce yourself? Just share a little bit of who you are and what you do, and then I have a bunch of questions for you that will hopefully be valuable to those listening.
Sure. Well, as you mentioned, we are Peak Wealth Management in Plymouth. We also just moved into Plymouth from Ann Arbor. My lovely wife, Jennifer, and our 3 children are in Plymouth, changing schools this year and getting ready for school to start next week. It'll be nice to have a 1-mile drive to work. I'm really looking forward to that. Anyway, started Peak in 2014, but have been in the business since 99. I'm a CFP, and we manage about 250 million for our clients. That's our assets under management, and we're growing. Jim just passed the CFP. Preston also just passed the CFP exam, and we hired Connie this year, so we have 6 warm bodies here, and we're running out of space already.
Very cool. Congratulations. That's because you're doing good work. And for those of you keeping track at home, if you want to do the math, I account for about 60% of his overall business and volume under, just in case you were wondering how that all worked out. You can do the math on that.
I cannot confirm nor deny that.
Yes.
But we did remodel the office in 2019. And like I said, we're running out of space already.
Good for you. Good for you. So thinking of remodelers who are listening to this, and if you have a question related to retirements and Roths or this or that, type them in the comments. I told Nick how cool this is where people comment live. So I'd like to see a few of you who I see are watching live to comment live. But I wanted to start by kind of saying, all right, if for those of people listening where, I'm not doing any investing right now, I should be putting some money away, or I don't feel like I'm putting enough money away. What do you say to the person that's kind of feeling maybe a little discouraged or feeling behind? Where should they start? What should they be thinking about, or give them a pep talk?
I think you got to start with the foundation, which I believe is cash flow, right? Let's build a balance sheet. Let's look at your cash flow. What's your income? What are your expenses? And if we're thinking about our personal budget, like a business, right? We have our income and we have our expenses. What do we have to work with, right? Are we operating on a deficit? In that case, we have some really heavy lifting to do. But if we're operating on a surplus, well, we just don't want that money to pile up in the bank account. Let's put together a plan for it, and then we can trust that plan later, right? So anyway,
we're trying out a new tagline, by the way, people. Yeah. Trust the plan. That's why it's come up twice.
Trust the plan. Okay, so if we have a surplus, right, we need to get enrolled in our company's 401 or start a Roth IRA if we're eligible. We need to start, having our money work for you, having your money work for you. So someday when you can't work anymore or you choose not to work, the money is working, and that will replace your income. So I like to start with that financial planning foundation of understanding our balance sheet, our net worth, our cash flow situation, and then start putting money to work. Typically, the easiest things would be signing up for the 401 or a Roth IRA.
Gotcha. And, in the case of most everybody listening to this, they are the business owner themselves. So if you're a business owner kind of getting things started, maybe you have 4 or 5 or 6 employees, you're thinking about trying to offer some type of retirement plan or company match, what direction do people typically go, or what are some questions or thoughts on that?
Sure. So there's really 2 ways to answer it. The first is if you're a solo practitioner, right? So if it's just you and you do not have any employees, this would also work if you had 1099 employees, right, that are not officially on payroll. Back in the day, everyone would set up a SEP IRA, SEP, stands for Simplified Employee Pension. And this is basically like a 401k for one guy, right? And you can put in quite a lot of money. It's over 60,000 this year, but it is based on 25% of what you're showing the IRS of your Schedule C net income. So if you show 100, right, you can only do 25,000. Okay. But that is higher than a 401k, which for guys under 50 would be 20,500. But there is a newish way to go with a solo shop, and that would be a solo K or a single K. And the reason why that is, in my opinion, a more popular option than a SEP these days is because you can choose Roth on that solo K. So like a Roth IRA, you can only do 6,000, but with a Roth solo K, you can do 20,500 as the employee and then have a matching formula as the employer. Okay. So you can hit those same high limits as a SEP, but you can choose Roth.
Gotcha. So again, that's if you're more of a solopreneur, and
Yeah.
then if you have a set of employees and you're wanting to offer something, what direction do people typically go there?
Typically, people will start with a simple IRA plan. And so, just like the name, right? It's pretty straightforward. It looks just like a 401, but it's kind of uh, the light version, right? You have less limits. Okay, I believe it's 14,000 this year versus 20,500.
Yep.
And there's a strict matching formula of 3%. Right, everyone gets a 3% match. So that means that if Bill puts in 3%, you have to match 3%. If Bill puts in 10%, you're only matching 3. See what I mean?
Yep.
If they don't contribute, then you don't have to match anything. But there's no administration, right? There's no
Very
tax
simple.
returns. Pretty simple. So typically, this is where people start.
Okay.
All right. And I think that you have experience in this area, don't
I
you?
do, and we're gonna talk about that a little bit more because that's where you start, and then maybe you go somewhere else. But I was thinking a little bit more about what you said at the start of, if I'm not doing investment, where should I start? And you started with that foundation of let's look at your cash flow, let's look at your even personal budget. And I wanted to sit in there and just share a couple other thoughts on that. Somebody commented when I posted this of talking about, hey, 401ks and simple IRAs, what should you think about? And Paul McManus, he's active in my Facebook group. He kind of said, let's not forget that our business is our biggest wealth building tool. When you continue to clean up and improve and turn your business into a more profitable entity, that's when it really opens up your ability to really stock some money away for investments. I was reading another piece of content, just happened to come across it yesterday, and it was talking about let's really build up the value of your business for your future gains in retirement. And I think that's important to if you're feeling stuck right now, or if you're not doing as much as you can, you got to either increase your income that you're generating from the business. You have to decrease your expenses. You need your balance sheet and your cash flow to improve so that you can put some real money away each and every month. But also, don't be discouraged. Start somewhere. I think we get so discouraged of like, well, it's just $250 a month. It's $250 a month. You were doing nothing before. You're doing $250 a month right now. That's awesome. You're also working out that muscle of saying, I'm moving this money into my retirement every month. So don't be discouraged if you're starting small, because getting that started, getting in that habit of doing that and working towards increasing it is awesome. And oftentimes we just kick it down the road, get started, and pay attention to the foundational things that Nick was mentioning. So I wanted to really encourage people there.
And I got to unpack this for a second. Also, okay. we have a question. I want to make sure that you saw that.
Oh, yes, I did. Yes. Go ahead and unpack it, then we'll get to that question.
Okay. So you're right. These guys who have their own business, this oftentimes will be their biggest asset, right? Certainly my income stream, my future income stream is my biggest asset. Okay. Mm-hmm. So we'll kind of, those are kind of the same thing, right? So we want to build that business. We want to reinvest with, marketing, and, that's where you come in and coach. We want to, reinvest with equipment and tools and human capital, but we can't continue reinvesting all the money, right? Like you were using that example of $250 a month. We have to translate or transfer our good or great income into a good or great net worth. Okay. And it can't all be on the balance sheet of the company, right? We have to strip money out of the company into our own name systematically. So on a behavioral finance point of view.
We're getting deep here, folks. Behavioral finance. Buckle in, sharpen your pencils, take notes.
It's a real thing, man. Right? If you set it up to do the $250 a month and you push the button one time and it happens automatically, right? That is something that you never have to think about again in theory, or at least not till next year when you raise it up to 300, right? But if you have to click the button or write the check or whatever the case may be every month, right? It's very tempting to skip this month. Okay. Yep. So behavioral finance, set it up systematically. Let's get it going so you never have to think about it again. And then back to the original question about how to set up a small business. If you do have employees, the simple is the most common way to start. And then you kind of graduate up to a traditional 401k, the real deal, right?
Yep.
And so the big time 401, now you have the higher limits, right? You have the Roth option, you have a discretionary matching formula, but sadly, we also have administrative fees where we have to pay people like our pal Scott, who's a third-party administrator. We have to pay them to draft our plan document, to make future edits to the plan document, which is all gibberish, right? In my world.
Yep.
But this is what Scott needs to do for you, so you're in compliance with the Department of Labor. In addition, each year he will file your Form 5500, your 401k tax return, which must be done every year, and you have to follow the different testing requirements, top heavy, all these things that are awful.
Yes.
But
So
we
I'll
have
kind
to
of
do it.
I'll share my story, and you're going to love this question. Doesn't the Roth have income limits? We're going to get to both those questions here in a second. But what Nick was getting at there is, oftentimes we start with a simple IRA. That's what I did at Remodelers on the Rise. And when you're getting to the point where you're wanting to maybe put more than the maximum in there, which, for years I wasn't, and then I'm taking retirement much more seriously the last few years, and been blessed to do that. But once you hit that, I'm thinking, okay, if I want to put some additional dollars away, and Nick and I talked about it, does it make sense to change my simple IRA to a 401k? My first reaction when Nick starts going through all this different stuff, and hey, you have to have this filing and that filing, I'm thinking to myself, wait, I got to spend $1,200-1,500 to get this to set up. I got to pay a fee every year to do this. My simple IRA is so easy. It literally doesn't cost me a dime. We don't have to file anything. What is going on? And then I studied it more and realized, okay, it's worth the hassle factor, because, the 13,500 moves up to 18,500 or 19 or wherever it's at. And the other big thing, which is what this person's getting at, is, wait a minute, I thought once you got to 160, 170, your ability to do a Roth kind of disappeared. I thought if you had a simple IRA, it's kind of tough to get a Roth IRA going. And what Nick Hopwood told me, or Mr. Roth is what they call him sometimes, is time out. If you have a safe harbor 401k plan set up, you can decide to put that, you can choose a number, but let's say 15,000 of that, and you can put that towards a Roth instead of a regular traditional 401k. And when I started running the math on that and learning more and digging into it, because Nick is my financial advisor, but me as the person, I need to understand this. I need to understand why I'm doing certain things. It's the same thing when you're sitting in front of a CPA. Yes, they're going to do all the filing. Yes, they're going to advise you, but you need to understand what the heck's going on. I realized, I think 39-year-old Kyle is going to be, or 60-year-old Kyle is going to be really happy that 39-year-old Kyle is making this shift, paying more in taxes this year and putting it towards a Roth, because all of that is going to grow tax-free, and it's going to save me a lot of money compared to tax savings in 2022. So that's kind of my story of how it is. What else would you add to that, or what else do you kind of advise people on there?
Let me add some color commentary to that. Okay.
Yeah.
So if you make too much for a Roth IRA, right, that's it. Okay.
Yep.
So the Roth 401k, the full-fledged 401, it allows you to do the 20,500 into a Roth as the employee. You can also put your spouse on payroll for 20,500 into a Roth 401k.
Yep.
And if you have a high deductible health insurance plan, you can do an HSA for I think it's 7,300 this year. And then because you don't have an IRA anymore, your simple IRA is now a 401, you can do a backdoor Roth for 6,000 each. Guess what, Kyle? I just got $39,000 per year into deferred retirement, all the earnings tax-free forever.
Yeah.
Okay, 39,000 each year into tax-free forever. I mean, sign me up, right?
Yeah. So just give the basic definition of a Roth, because I think everybody, oh yeah, I've heard of that. What exactly does it mean?
It means that your contributions go in after tax. Okay, so they've already been taxed, and then the money is invested, but all of the earnings on the money are tax-free forever if you follow the age guidelines.
Yep. Right. So that let's say we put $40,000 in a Roth this year. And if you're 60, you're probably going to advise people a little differently because we do the math and okay. But when you're in your 30s, maybe 40, I'm sure there's a point of time where it maybe teeters. But that $40,000 I'm putting in will hopefully by retirement turn into 100, 120, 130. And all of a sudden that $130,000 is totally tax free. Right now, I am going to pay more taxes this year on that 40,000. Typically, if I had a simple IRA, if I was making $200,000 and I put $40,000 in a simple IRA, my spouse and myself, we'd have a taxable income of 160,000. I'd pay less in taxes. I'm choosing to pay more now because there's going to be a big benefit down the road. So if any of that sounds interesting, what you need to do as a takeaway from this is study it a little bit, reach out to Nick. He can educate you on it, but dig into this and study it because these decisions can translate into several $100,000 of savings and difference.
Yeah, I've got a couple of episodes on our podcast where we talk about why I went all Roth. And so it really spells it out.
Cool.
So the question was, does Roth have income limits? Yes, if it's a Roth IRA. But if it's a Roth 401k, there are no income limits. You make $1 million and still do 20,500 in Roth.
Big difference. And then somebody else asked, difference between CFA and CFP, pros and cons of both.
Yeah, I'm wondering if they meant CPA, because CFA is Chartered Financial Analyst, and this is like the guy who analyzes big companies' balance sheets, income statements, and would be like a portfolio manager or a portfolio analyst. That's typically the people that are the CFAs. So as a CFP, that's strict financial planning.
That's certified financial planner.
Yeah, certified financial planner. It covers financial planning broadly, retirement planning, college planning, estate planning, tax planning, insurance planning, investments, not to the degree of the CFA. Okay, so it's all of these categories. I like to say, the way that we use our business model, we are the CFP, boots on the ground, right? Grassroots. Let's talk about, budgeting and balance sheets and retirement projections. And I don't want to be your stock picker, right? I don't want to be your mutual fund analyst. Okay. What we want to do is partner with these CFAs, right? Like the large world-class money managers that we partner with, they have hundreds of these CFAs, right? So we partner with them, and that's our business model. We're the CFP partnering with the CFA.
Gotcha. Cool. So whenever I record a podcast or think about the people listening live or listening to the recording, I'm always thinking of what's the takeaway? What is the value? What are you going to do with this? Hopefully some of the things you've heard so far is one, maybe on a more advanced scale, kind of piqued your interest on, maybe not a simple IRA. Maybe I need to look into a solo 401k, the safe harbor 401k. I need to dig into that more. Maybe you listened and said, okay, today's the day I need to decide to take this more seriously. Every day that goes on, every month that passes, every year is just kind of putting me a little further behind of where I want to go. And I need to take this more seriously. And you're going to call your financial advisor today, or you're going to take and up what you're contributing each month. So that would be huge. The other thing that I hope would be a takeaway, and we haven't touched on it yet, but I just wanted your quick thoughts on it before I ask you about investment properties, is, everyone that is planning to retire in the future, and we don't know exactly what that's going to look like, and we're kind of guesstimating what we're going to want to do in our later years. But if you are 39, if you're 47, if you're 52, if you're 43, and you haven't sat down with somebody to actually kind of forecast and create a plan that says, all right, if you continue at the pace you're going right now, and if you want to have this much per year in retirement and an income coming out, and you're projecting to still be bringing in maybe $4,000 a month in income, here's what that looks like. If you don't have a plan where you've looked at those numbers, sit down and have somebody, a CFP, Nick, or if you already have somebody, sit down and really review that. It gives you peace of mind, and it gives you a roadmap of what you're going after. I'm guessing you probably agree with that, Nick.
100%.
Yeah.
There's another question. What do you mean income limit when you're talking about the regular Roth IRA?
Sure.
Well, if you're married, the income limit is 204 this year. So if you make over 204, you're not eligible for a Roth IRA. It's that simple. Okay.
Yeah.
If you're single, the limit's 129. All right. So we have to be aware of these values of these income limitations with the Roth IRA.
Okay. Sorry, the difference between financial planner and a registered investment advisor.
Yeah, this is generally synonymous for most of us, right? So Peak Wealth Management is a registered investment advisor. That just means that you are a fee-based advisor where you offer fee-based work. And you're either registered with the state or the SEC. Over 100 million, you're registered with the SEC. So you're, eligible to work with anyone nationwide. And most of these RIAs, which is what we call them, most of the RIAs will do financial planning, right? And hopefully they're a CFP as well. But some don't, right? In some cases, either they just don't offer financial planning, or they're just not doing very, very much of it. Okay. So most of the time it's the same, but sometimes it's different. So you should ask.
Got it. We'll get back to the other question in a second, but comment on that comment I made, that little diatribe I had on having a plan and the importance of that.
I think it's everything. I mean, that's where we spend almost all of our time talking with clients, learning about what their goals are, learning about, all the stuff I already said. And the investments are just the vehicle that drives that plan, that fuels the plan. Every time we meet with someone, we put it up on the screen and say, here's where we are today, right? Our base plan is if we keep doing what we're doing. So it's actually very rewarding when we're meeting with someone new and their base plan looks really terrible, really crummy, because they're not doing enough. But they have resources, they have time, where if we make this change, this ABC change, maybe it's, maxing out, maybe it's adding a Roth IRA, maybe it's adding an extra mortgage payment to get the debt curtailed by retirement age, or maybe it's delaying Social Security, or working 1 or 2 more years, right? Just a couple tweaks here and there, and we can show them how now the plan looks great. Okay. And then hopefully that becomes the new base plan. And then when we meet again in 6 months or in a year, we make sure that we're still on track with our base plan, or do we need to be more aggressive? What if it's halftime, Kyle? It's like halftime of your career. Okay. Are you ahead? Is the score tied? Or are you behind? And if we're behind, we can, run our hurry up offense. We can run a full court press, right? We have to, do more to catch up, right? That's the idea.
Good basketball analogies. Thomas Hunt, he's going into his junior year. He's been training hard for basketball. He's been putting on some lbs. He's been bulking. He's up to $167.
Wow.
I mean, 6'2", 167. He's still pretty young, but it's starting to build out. I do not want to arm wrestle him like I did 3 months ago, because I think he can finally take me.
No, you got the old man strength.
You think so?
Yeah.
We'll see. Like I said, I don't really want to take him on right now. All right. So a couple other questions. One, I want to ask you about investment properties, because we're talking to remodelers who are very attuned to the market, know how to fix things up, have the resources to do it. And I think it's very intriguing for people who are experts in the real estate arena to perhaps think about diversifying their retirement with investment properties. So I'd love your thoughts on that. And then the second thing I wanted to ask you about, and we'll go maybe a couple minutes over, is time out, Nick. The market's crazy. It's been up, it's been down, it's been nutty this year. I'd like for you to just kind of maybe close with that, of kind of explaining to people, hey, here's the reality of what's going on. Here's historically what it looks like, and maybe give them some perspective on that. So that first one of investment properties, if you are a remodeler who really loves real estate, what could we be thinking about there? Or what's the balance between retirement and accounts versus investment properties? How do you advise people on that?
Right. So, my portfolio is tied to the markets. My income is tied to the markets. The value of, our enterprise value is tied to the markets. So real estate for me is a way to diversify away from the markets. We started buying properties in 2005, and we've acquired 31 doors. So for me, this is our way to diversify and generate a pension for ourselves in retirement, because, you and I don't have a pension. So that's the bottom line for me, is why I got into it. And I found that I found a little niche, right, with duplexes. Like, we're kind of small time, right? But it's getting big. And I think that if my job is real estate and I'm handy and I know plumbing and I know electrical work and I know carpentry, like I'd be doing it aggressively, right? I can't do any of that stuff, right? I call Chuck, okay? But if I knew how to do that stuff, I would definitely try and do more. So I'm looking at like 8-9% cash on cash rentals, even with the prices high, because the rents are high too. And if you use a little bit of debt, the rate of return goes up dramatically, but that's more risky, you know?
Yeah.
But
So
I really love it.
even what you just said there, a couple things. One, do you love it? Do you love the hassle factor of real estate? You
No,
know,
no, no, no.
right. Not that part, but you have to open it up there. And then, you start clicking around and people love to talk about, well, cash on cash, 8%, 9%. So the question of is real estate a better investment? Is it going to make you much wealthier than going the route of a retirement account? How do you answer that?
Well, I would say if you are making 8 or 9%, that's on par with the S&P 500. Okay.
Yep.
You can just buy the S&P with no work. If you're doing the rentals, you're going to get those calls about the hot water tank that's out, right? And whatever else.
Yep.
But if you're using a mortgage, right, your return can go like into the 20%. But you have to be careful, okay? Because that's how you get sunk, right? Leverage can sink you. And in 2008, I was scared because we bought them right, but we had debt.
Yeah.
And I was very nervous. So I didn't like that feeling. So I decided I didn't want to do that. So we pay cash.
Good. That's good advice. That's good thought. Yeah, have a balance. A couple of people asked, are you fee-based or product commission? Are you fee-based, fiduciary, or broker?
Yeah, fee-based. Okay, so the definition of fiduciary is fee-based because we make the same regardless of whether we recommend strategy A or B. There's no incentive for us. We are making it recommendations for the investments and our financial planning strategies based on what's in your best interest and not ours. So fee-based fiduciary.
Okay. So do I pay you a percent? Is that how it works? Or is it a flat fee? I think a percent, right?
1% is generally 1% is a very common industry fee. Mm-hmm.
Yeah. Okay, cool. I don't know. It just kind of comes out or I don't even notice it. And you're just such a steal, so I don't even notice it. Okay, so there's answers to that. Was there any other questions we missed? I think we hit everything on there.
You had the markets question. I can touch on this very briefly, right?
Yes, please.
So when we do our financial planning, we only show a projected return of 5% because, if we can, if the plan works with this low conservative projection, then I feel really good about the future. The market historically, 8 point something, up 3 out of 4 years. 19, 20, 21 were all good market years. So maybe this is the fourth year, right? The 3 out of 4, and now this is our down year. But at the low point of June 16th, the S&P was down 25% year to date. And now it's more like 10% year to date down. So it's come back more than halfway. So
just in a month and a half or 2 months. Yeah.
And so we don't know where the back half will finish, but we do know that usually there's these intra-year drawdowns, which can look ugly, but oftentimes we close much higher than where we were at that low point. So, and I also say, the GDP prints for the last 2 quarters have been negative, which is technically a recession. But a lot of the other indicators are not flashing recession. So it's kind of a mixed signal, right? Yeah, like the market down 25 is telling you there's a recession coming. Okay. But usually the market starts going down before the recession hits, and then it starts going back up before the recession is over. Okay. So maybe the market's telling us that the worst is behind us, but I also worry about a double dip. So we could find ourselves back at those June 16th levels. You just don't know.
Yeah.
So we got to trust the plan.
Yes, we do. And I think the big thing there is, I was walking into a meeting. It was a couple months ago. I don't remember the exact stats, but somebody wanted to talk about kind of the market and how people are feeling about it, because it is impacting even remodelers. When you have a client that you're talking to and the market's down 25%, and that $800,000 they had in retirements now, sitting at 600, they're thinking maybe a little differently about, is it now the time to move forward with that project? So it's definitely something that impacts people's psyche, plus gas, plus this, plus election coming up. But it's good to step back and be reminded that it goes up and it goes down. It goes up and it goes down. And if you live day by day by logging into your retirement account day by day, it's going to drive you bonkers. And it's
Absolutely.
important to step back and think year by year and realize there's going to be some wins, there's going to be some losses, but we trust the plan. And we also look at just the long term of, you know what, we're going to average X amount. And when your plan, like you said, when your plan is very conservatively based at 5% return, that's pretty safe.
Yeah.
If your plan is based on, well, I think we're going to do this and this, and it's going to be at 12%, that's a much riskier plan to get you to your end result. So
yeah. If your plan is based on 12%, you're setting yourself up for disappointment.
Yes. Good. And so this has been great. We got a couple other questions that just popped in.
I'll keep the answers super short. Okay.
Okay. So how much do I need for my retirement? I know that question is too big, but do you have any guidance or something to read on this?
Question is too big. You could say, hey, I got $1 million. That's good, right? I'm like, yeah, that's good. But if you're spending 10,000 a month, it's not going to be enough. Okay.
Mm-hmm.
So it all depends on what your lifestyle is and what other resources you have. So I can't answer this question. Something to read. I would talk to a professional, right? Talk to a CFP. And, even if you don't have much now, most people can have a phone call with you and point you in the right direction.
Yeah. And it's something, and if I could add on to that, it's sometimes when a remodeler asks a question to me of like, well, what should my markup be? Or, what should this be? Well, let me understand your situation a little bit more. The answer for everybody is different, just based on your goals, based on what you're trying to achieve and do. So number one, great question. How much do I need for retirement? Great question. Now go find the answer by sitting down with an expert and going through what your future plans are, what your goals are, and then the question will be very apparent. You're on pace, you're behind, you're ahead of the game. Awesome work. There's answers out there, but you got to dig in and pursue it. And then Ethan said, how would you recommend someone get started into real estate /rentals?
Without a doubt, I would read the book by, I believe the author is Gary Keller from Keller Williams. And it's called The Millionaire Real Estate Investor.
Okay. Bada bing, bada boom, folks. Nick, that was very helpful. We're going to end in with this. One, tell the people how to get a hold of you if they're interested in reaching out. And also what states you serve. There are people listening from around the country, so maybe mention that. And then close by saying, if there's anything that you want to really emphasize, we covered a lot of different topics, but hey, if you heard nothing else today, make sure that you heard this. Close with that, if you would.
Sure. Okay. So you can reach us at peakwm.com, WM like wealth management. You can find my email. You can book online if you want to talk further.
Cool.
We serve all states.
Oh,
so
cool.
It's not an issue because we're SEC licensed, registered. And I guess I'm going to drive home the Mr. Roth point. I feel like tax rates probably will be higher. Okay. The deficit is not going away. Right. And I think that you might find yourself in a higher tax rate in retirement than you are today in some cases. Right. And if it's the same, then why not just get it over with? That's my view. So Mr. Roth all the way.
Cool. Nick, that was fun.
Yeah, it was.
Appreciate the time. Reach out to Nick. He's somebody that I've known and trusted for, has it really been it's probably been like 18 years. Time flies. I can't believe how handsome we still are after all these years. That's surprising. But everybody, thanks for all the live comments too. That made it fun. Reach out anytime. Appreciate you listening. Thanks so much, Nick. Talk to y'all next time.